Welcome to Luck Scout Economic News and Strategies. The U.S. economy received a mixed bag of news on July 30, 2024. This date marked a significant moment as two key economic indicators were released, painting a somewhat contradictory picture of the nation's financial health. Consumer confidence surged to a two-year high, suggesting optimism about the economic outlook. This rise in consumer confidence indicates that people are feeling more secure about their jobs and financial situations, leading them to spend more freely. However, job openings dipped slightly, raising questions about the strength of the labor market. This slight decline in job openings could be a signal that businesses are becoming more cautious about expanding their workforce, possibly due to uncertainties in other areas of the economy. This confluence of data presents a complex picture for economists and investors alike. While consumer confidence is high, the dip in job openings suggests that there may be underlying issues that need to be addressed. Understanding the interplay between these two indicators is crucial for navigating the current economic landscape. Analysts and investors must consider both the positive and negative signals to make informed decisions. The surge in consumer confidence is a positive sign, indicating that Americans are feeling more secure about their financial futures. This increased confidence can lead to higher consumer spending, which is a key driver of economic growth. This optimism can translate into increased spending, which fuels economic growth. When consumers are confident, they are more likely to make significant purchases such as homes and cars, which can have a ripple effect throughout the economy. On the other hand, the dip in job openings, while slight, could be an early indicator of a slowdown in hiring. If businesses are hesitant to hire, it could lead to slower job growth and potentially higher unemployment rates in the future. This bears watching as it could impact future economic expansion. A sustained decline in job openings could signal broader economic challenges, affecting everything from consumer spending to stock market performance. The following sections delve deeper into each of these indicators, exploring their implications for the U.S. economy. By examining the factors driving consumer confidence and job openings, we can better understand the potential future direction of the economy. By understanding these dynamics, we can gain a clearer picture of what lies ahead and make informed investment decisions. Whether you are an investor, a business owner, or simply someone interested in the economy, staying informed about these indicators is essential for navigating the financial landscape. The Conference Board Consumer Confidence Index is a closely watched barometer of economic sentiment. It is a monthly survey that measures consumers' attitudes and expectations regarding current economic conditions and the short-term outlook. The index takes into account factors such as consumers' feelings about job security, income prospects, and spending plans. A higher index reading signals greater optimism among consumers. They are more likely to make major purchases, invest in the stock market, and feel secure in their employment. Conversely, a lower reading suggests pessimism and caution. Consumers may hold back on spending, delay major purchases, and become more risk-averse. Understanding the CB Consumer Confidence Index is crucial for investors. It provides insights into consumer behavior, which drives a significant portion of economic activity. By tracking this index, investors can gauge the overall health of the economy and adjust their investment strategies accordingly. The recent surge in consumer confidence can have a significant short-term impact on the U.S. economy. When people feel more secure about their financial future, they tend to spend more freely, which can have a ripple effect across various sectors. When consumers feel optimistic, they are more likely to open their wallets and spend, which boosts economic growth. This spending is not just limited to essential items but extends to luxury goods, dining out, and entertainment, further stimulating the economy. This increased spending translates into higher demand for goods and services, prompting businesses to increase production and hire more workers. As companies ramp up their operations to meet this demand, they often invest in new technologies and infrastructure, creating a positive feedback loop that can lead to even more job creation. This surge in economic activity can lead to higher corporate profits, potentially boosting stock prices. Investors, seeing the potential for higher returns, may pour more money into the stock market, driving prices even higher and creating a sense of wealth that can further fuel consumer spending. Sectors that are particularly sensitive to consumer spending, such as retail, travel, and entertainment, often experience the most immediate benefits. These industries see a direct uptick in sales and bookings, which can lead to more hiring and investment in these areas. However, it's important to note that these short-term gains can be fleeting if not supported by sustained economic growth. If consumer confidence wanes or if there are external shocks to the economy, the positive effects can quickly dissipate, leading to a slowdown in spending and economic activity. The Federal Reserve also keeps a close eye on consumer confidence as it can influence monetary policy decisions. High consumer confidence can signal to the Fed that the economy is heating up, which may lead them to adjust interest rates to prevent overheating. High levels of consumer confidence, particularly if they lead to inflationary pressures, may prompt the Fed to raise interest rates to cool down the economy. This balancing act is crucial to maintaining economic stability, as too much confidence can lead to unsustainable growth and inflation, while too little can result in stagnation. Additionally, high consumer confidence can lead to increased borrowing and credit use, as people feel more comfortable taking on debt. While this can further boost spending in the short term, it also raises concerns about long-term financial stability and the potential for increased default rates if economic conditions change. Small businesses, which are often the backbone of the economy, can also benefit from high consumer confidence. Increased spending can lead to higher revenues, allowing these businesses to expand, hire more employees, and contribute to overall economic growth. In communities across the country, the effects of high consumer confidence can be seen in the vibrancy of local markets and the optimism of residents. This collective sense of well-being can foster a positive environment for further economic development and community engagement. While the short-term impacts of high consumer confidence are noteworthy, the long-term implications are equally significant. Sustained consumer confidence can create a virtuous cycle of economic growth. When consumers feel secure about their financial futures, they are more likely to invest in education, save for retirement, and start businesses. These activities contribute to long-term economic growth by fostering innovation, increasing productivity, and creating jobs. Moreover, sustained confidence can lead to greater business investment. Companies are more likely to expand operations, invest in research and development, and hire new employees when they anticipate continued consumer demand. However, it's crucial to acknowledge that consumer confidence is not the sole driver of long-term economic growth. Other factors such as government policies, technological advancements, and global economic conditions also play a crucial role. The Job Openings and Labor Turnover Survey, or JOLTS report, released monthly by the Bureau of Labor Statistics, provides valuable insights into the state of the U.S. labor market. The report tracks job openings, hires, and separations, offering a comprehensive view of labor market dynamics. A high number of job openings typically indicates a strong labor market. Employers are actively seeking workers, suggesting confidence in the economy and their own growth prospects. Conversely, a decline in job openings can signal a softening labor market, potentially indicating an economic slowdown or a shift in hiring practices. The JOLTS report is a lagging indicator, meaning it reflects past hiring activity rather than future trends. However, it provides valuable context for understanding the current state of the labor market and its potential trajectory. The slight decline in job openings reported in July 2024, while not a cause for immediate alarm, warrants careful consideration. This dip, though minor, could be a signal of underlying shifts in the economic landscape that merit our attention. It could be an early indication of a cooling labor market, potentially reflecting broader economic trends. A cooling labor market can have far-reaching implications affecting everything from consumer spending to business investment. Several factors could contribute to this decline, including economic uncertainty. When businesses face uncertainty, they often become more conservative in their hiring practices, opting to wait and see how conditions evolve. Global economic headwinds or domestic policy changes can create uncertainty, making businesses more cautious about hiring. For instance, trade tensions, geopolitical instability, or changes in regulatory environments can all play a role in shaping business confidence. Advances in automation and technology may lead to some job displacement, reducing the need for certain types of workers. As companies invest in new technologies to improve efficiency, the demand for certain manual or repetitive tasks may decline. Wage pressures are another factor. Rising wages can squeeze profit margins, leading businesses to reconsider their hiring plans. As the labor market has tightened in recent years, wages have risen. This is great news for workers, but it can pose challenges for employers trying to manage costs. Some businesses may be hesitant to hire at these higher wages. They might opt to delay hiring or look for ways to automate tasks instead. It's important to note that a single month's data point does not necessarily indicate a trend. Economic data can be volatile, and it's crucial to look at longer-term patterns. The decline in job openings could be temporary, and the labor market may remain strong overall. Seasonal factors, such as the end of a hiring spree or temporary layoffs, can also influence monthly data. However, it's essential to monitor this indicator closely in conjunction with other economic data to assess the long-term health of the labor market. By examining a range of indicators including unemployment rates, wage growth, and labor force participation, we can gain a more comprehensive understanding of the labor market's trajectory. In conclusion, while the recent decline in job openings is noteworthy, it is just one piece of a much larger puzzle. Staying informed and vigilant will help businesses and policymakers navigate the complexities of the evolving economic landscape. We are not licensed financial advisors. The information provided in this essay is for general knowledge and entertainment purposes only, and does not constitute professional financial advice. It is essential to consult with a qualified financial advisor before making any investment decisions. Please also read our terms and conditions before using our website. Please like the video and share it with others. Thank you for watching.